All, I'm Sham and I have Kishan with me.
Hi everyone.
Welcome to Free Float. Today we'll be discussing one of the most popular in trading slash investment investing strategies called momentum. So our newsletter is about the origins of momentum as an academic factor, in the sense that guys with PhDs looked at momentum, created long short portfolios, and showed that it was a valid and persistent anomaly. Um, so before we dive into that, a little bit of history. What academics did was nothing new. Uh, Kishan, I'm sure you've read the Market Wizards
Yeah,
series, right?
yeah.
Uh,
Like one of the first things I read.
yeah. So that was set when in the 60s and 70s, the first book.
Yeah, I think towards the 80s. I think a lot of successful traders came in the 80s when the bull market really started.
Right. Okay. So it's late 70s, early 80s, right? So that was the
Yeah.
setting. And, and most of the guys, if you actually read between the lines, were trend followers who are looking at, moving averages and so on.
Yeah.
And they used these trends to time trades and, and go short, long and all that stuff. So when you look at it, like this whole concept of trend following is like the oldest strategy in the market, right? So the whole trend is your friend kind
Yeah.
of thing. If you read the Livermore book, it pretty much shows that he's a big fan of the trend, like let it ride kind of a thing, as long as it's in
Yeah.
your favor. So there is nothing new about momentum, but what academics did was actually look at it in a scientific way, created long short portfolios, and
Yeah.
showed that the spread was stable. Um, and I think one of the benefits, I don't know, I wouldn't call it benefits, but what happens in an institutional setting is that if a trader goes to, a big fund and says, I'm going to use moving averages to trade, he'll probably get laughed out of the room saying, this is
So
bullshit.
simple, and then
Yeah.
everyone has done it, and you think you're so smart. People in the diapers did it here.
Yeah. So, but if you go and say, I'm going to build this momentum model, which is risk adjusted, and I'll do this low wall, and then, I'll dynamically do some blah, blah, blah. So, then you probably have the year. And, one of the benefits of academics finally coming out and saying momentum is a valid factor was that it became sort of saleable to big funds and endowments. So momentum was no longer the pariah factor, right? So if you go until I think even like a decade after the paper came out, momentum was considered like some voodoo stuff that traders do, and not a valid investment factor for like the serious big boys, right?
Yeah, and I think it just went against the grain of so many traditional investors that they just couldn't accept it. That this is a like a valid investment strategy which can deliver consistent returns and, like you said, persistent.
Yeah, yeah. So, but I think the biggest problem with momentum, and I feel most of these factors work, is behavioral, right? So what happens is, if you refer to our previous, charts of these spreads of different factors, you will see that they go through multiple years of underperformance. So what happens during that time is, investors lose faith and they exit the strategy. And soon after the last, bull exits the stage, that particular factor starts performing again. and then they herd back into it. So this cycle keeps continuing. So so that is part of the reason why these factors are thought to work and be persistent, because sticking to it is very, very difficult. And and that's one of the reasons why they kind of work. So that's one of the rationales given, and it's true for momentum as well. So if you look at momentum portfolios, they crash pretty badly, right? So, especially if you're long only, then it's reasonable to expect like 40 to 50% drawdowns, every 3 to 4 years. So what happens during this time is investors lose faith, and they say, "What is this nonsense? This is never going to work." And there'll be enough around news flow around that time to kind of freak anybody out. So, so you'll be like, nah, give me something safe. And the worst part about momentum, it's also high transaction cost. So, irrespective of how you build a portfolio, whether it's a monthly rebalance, weekly rebalance, whether you put a stop loss, don't put a stop loss, there's no escaping the fact that it is a high turnover strategy. And when it is underperforming and you're still churning, right? It's like a double hit to your portfolio. So you're losing money on the churn as well. So it is not for the faint of heart. Let me put it that way.
Yeah.
And because of this, so I've listed about half a dozen different ways of measuring momentum, right? So different people have taken a crack at trying to reduce this churn, trying to reduce drawdowns, trying to reduce computational load as well. So they've tried and done different things, but ultimately there's no escaping the fact that it is a high turnover strategy that frequently crashes.
And I think during a phase of a bear market, momentum is dead. I mean, it's a strategy that has a uh, long drawdown period. Like in the sense that the period of drawdown is pretty long. I think the recovery period is much longer than some other strategies. So I think you can have, if you're investing momentum, you should be prepared to have at least 2 or 3 years of not just underperforming, but just it being dead, and then it wakes up like it wakes up, and then it starts performing again. But those 2 or 3 periods, years of periods, are where your faith is tested.
Yeah.
Yeah.
So, and the worst part is, you're still like if you are an index investor and just invest in Nifty or S&P 500, right? You can at least say that, look, it's low cost, so I'm not paying anything for this.
Yeah.
But if you're doing momentum, then you are paying. So every week or every time there's a rebalance, every month, you end up paying for it. So it's
and you can't say I won't rebalance, because then that strategy will not work.
Yeah. In fact, one of the charts that I have posted on the on the newsletter is our own momentum strategy. So it's like a monthly rebalance thing. It's a relative momentum strategy, and you can see the 2-year period. From 2018 through 2020, when it just it saw a drawdown of close to 40%. Slowly, it has kind of recovered from there. But even with a drawdown of 40% in the middle, you're looking at a 20% plus, CAGR, right? So annualized returns of more than 20%. So my point is that unless you have the capacity to, see your portfolio kind of bleed out and not do anything about it, momentum is not for you. But if you are that kind of person who can handle that stress, then the rewards are there, right? So I posted that thing because relative momentum is my favorite way of looking at momentum. So, to kind of explain it within like 30 seconds, it's basically comparing each stock with all the other stocks in the universe and creating a sort of distribution curve of returns and of outperformance, and using that distribution to to rank stocks. So Kishan, I think you also have a momentum strategy running, right? So how are you looking at it?
So I have probably 5 or 6 different types of momentum strategies, and they all do different things. So some of them, some momentum strategies just try to capture a short burst. So you say the index or the stocks have moved up significantly in a given period, then you're just trying to capture the last leg of the move. You're not trying to capture a big move, but just the last leg. Then you have strategies where stocks which have run up significantly in the last 6 months or 7 months. You go buy them, which goes when I first read about it and thought about it. It went against every grain in my body. That you're buying something that's already gone up. Most people how much more it will go, or stuff like that. And my all attitude was like, it was like if some stock has gone up 100% in 6 months, it's not going to go up more. I mean, but it took a lot of. But when I tried it out, tested out, I also got lucky because I tried to test it out in 2013. So there was a good period where you got all kinds of, and I did it at a time when all stocks I got at that particular period are ones which everyone talks about as the best momentum stocks, like Avanti Feeds and stuff. And then the other type of strategy which I like is also, the thing is in momentum, I've known that it's very important to have a fundamental filter, because without having a fundamental filter, you get a lot of riffraffs. Especially in India, you get a lot of operator-driven stocks and stuff like that. So you just have to guard against it, because so sometimes you see stocks going up 100-200% in like a couple of months, and you don't know why. And if you cannot justify why, from a intuitive perspective, then there's something like fishy about it. And the thing is that some of them are just pump and dump,
Right.
And yeah.
I mean, the other problem with momentum is stocks that don't go anywhere after climbing high. So there are a lot of stocks like that, especially like in IT and all that. So like the whole sector is stable, but they get re-rated, so all of them jump, right?
Yeah.
And your momentum, algo picks them up, and then since the whole sector is stable, there's no volatility between those names. So like Infosys, TCS, Wipro, they all like kind of dead, but they just jump and they die. So
yeah, and also I mean, if you're talking about larger, I think momentum works much better, or the strategy works much better in smaller or medium-sized companies, just because they're not tracked that much, right? So when there's sudden interest in a particular stock, for whatever reason, those spurts are more the spurts end up being trees, to say, much more faster. While because in Infosys TCS, pops, because of of whatever reason, but because it's well tracked, and and research, so it gets to its intrinsic value, or the market's fair value pretty quickly, and then it doesn't matter. I think it works much better for smaller companies. But even if you have a large cap momentum portfolio, it's my belief that it should outperform the index at least by 2 or 3%. Like most momentum strategies which I've tested in, which is the NSE 100 universe, they outperform the market by at least by 3.5%, which doesn't seem a lot, but over like 12, 13 years, it's pretty big difference. And they also outperform most mutual funds, like, most large cap mutual funds. So you can have a strategy where you feel pretty smart that you did it yourself and you beat the likes of Prashant Jain and stuff. And you did, and it's a pretty simple strategy. I mean, obviously it's a back test and all that. And in 12 years ago, Prashant Jain would say I was in diapers.
No,
So
look, the problem I have with people comparing their chota mota cottage industry portfolios with some 4,000 crore, you
yeah,
know.
yeah. I mean, sizes, like we discussed it last week. Right? One is, no one's gonna fire you for buying ITC, and two is, you can't buy, you can't just have. I mean, there's a lot of problem of size, so you can't buy small. I mean, just buy what. Just buy momentum strategy. So I get it.
So, coming to size, right? So the thing is, I'm not completely convinced that momentum has a size problem, because if you look at the US case, so you have two ETFs there, MTUM, and there's one more Invesco they listed in the newsletter. They each manage 11 billion and over 15 billion, so about um, over $25 billion in momentum strategies. So they don't seem to have a problem, in trading momentum names. So I feel, if you're willing to sort of, get a bit creative in the way you set up your portfolio and how you rebalance it, I think you can overcome those capacity problems. But at the end of the day, you will need a lot of help from market makers and investment banks to pull it off. It's not an easy feat, but it is doable. You can have a staggered momentum portfolio that rebalances, without having a huge market impact. Um, so given this backdrop, I think Kishan, you should explain what we're trying to do with our all-star portfolio, and how it makes sense for investors, and why they should consider subscribing to it.
Okay, so what the All Stars portfolio does is that it tracks companies which have beaten their, like, all-time highs. I mean, the previous all-time highs, and they're trending higher. So generally, companies cross the all-time high when there's a lot of interest in the company, or in the particular sector, and for whatever reason, whether the company's prospects have changed, or or the market just views the sector or the company more favorably now. There's something that changed for the stock to move to cross the all-time high. So stocks do that only when something dramatic has happened, and so you're buying companies where there's a lot of interest in the stock. All right, so you're moving with the trend or with the market. So you're betting that that the market has figured out something in this particular stock, and then you're trying to ride that that wave.
Right.
So I mean, if you can get past the fact that you're buying a company that you missed out while buying, like, say, 1 year ago, if you can just get past that, it's a good strategy in the sense that it makes sense that you're buying stocks which are moving up.
Right.
And
So how do you exit it? So is there like a
so
criteria?
so the way we do it is that we have a 15% trading stop loss. So a 50% drop is significant, from top, where you can save for sure that the trend has changed. That so say you can say that okay, when it moved up, that might have been a speculative mania, and this stock came in out into that fall, and now it's reversed, and you can be pretty sure that if a stock falls below 15%, then that trend is reversed. I mean, it can come back up, but at least for that time period, it's it's. I mean, that trend is reversed. I would say also it's not a portfolio for everyone. It's a very you must have a high risk appetite. There's a very high chance of risk of principal. If you get a timing wrong, like especially in this uncertain times, today market's trending high because of liquidity and stuff. Tomorrow this all can change, and you can have a sharp drawdown, and you could have just entered at the top. So you will face those difficulties, and also momentum makes, I think, sense as a part of an overall strategy. It just cannot be your only strategy. So I think everyone should, who is interested should know that all these things are a definite possibility, and this is more like I would say this is like a great topping for your portfolio, because it will without taking too much risk, it will give you that outperformance that you need to for your investment performance to look much better. But it's not like the entire portfolio.
Right. So we are going to be doing this on Substack, right? So people can just subscribe to it as a newsletter, and we'll be sending them the initial portfolio along with all the trades that need to be done. How does that work?
Yeah, so we'll put this up on Substack. The portfolio, and then the portfolio will be for subscription. So people can see what we're doing on the portfolio, the changes, whether they're new stocks or a stock has hit stop loss. We will send them an email when that happens. Each time that that event happens, we will send them an email. These are not necessarily price sensitive, so I would say that if you get an email, say on Friday, you can still execute it on Monday, Tuesday. There would be price changes, but I don't think this strategy is that sensitive to say that it needs to be executed on that minute or that day. And the other thing is we will put up more strategies also in the future, and so and we will do it in the same way. So we'll have an all-star portfolio, we will have maybe something else in the future, and each portfolio will have its own theme and own its own objective and why it fits into an overall strategy.
Right. And also, I think the reason why, so we are doing this through Substack, right? So number one is, look, we have, on StockWiz, if you open a brokerage account, you can have access to a lot more of these strategies yourself. But we do have like a minimum account size. We have some strategies up on small case, but that requires investors to actually commit money, right? So commit funds to do that. So the reason why we are doing this Substack thing is, this is like a third way of, it's a different way of delivering a portfolio. In the sense, it allows the investor to choose what he wants to do with it. Right.
Yeah, and also just to see what you're doing, for a while, you have to understand what portfolios. To view our research, to view our strategies, without committing money, or without like he gets to see what we're doing without putting his own money. So it's also just for the sake of information.
Okay. Cool. So, with that, we will, wind this up, and, thank you for, coming on to Free Float, and do hit the subscribe button, because, it is something new that we are trying to do, and we would, be greatly appreciative of your, of your subscription and support. Thank you very much. And we will see you next time.
Yes, thank you.